Good day to whomever it may be concerned. My name is Nick, and our financial group will present to you today of our analysis on the current exchange rate of the pound sterling against the US dollar, as well as the euro against the pound. Furthermore, we will provide a forecast on the value of these currencies in the near future. Firstly, we will look at the current exchange rate as our recording date 18 September. We can see that for every 1 euro, you will be able to exchange for 0.88 worth of pound, whereas for every pound you can exchange for 1.35 worth of US dollar. There are many factors and indicators that influence this exchange rate, such as relative interest rate, relative inflation, relative growth rate, as well as the various respective government intervention policies enacted during the course of the year. Here is a brief definition on the relative interest rates of countries. Relative interest rates are the capital offered to lenders when borrowing money. Therefore, if a country has a higher interest rate compared to another, it attracts foreign investors to invest in that currency as the capital is being offered more than its local interest rates. However, this can be mitigated by the inflation of that country. These are the current interest rates for our respective chosen countries. 0% for the euro area zone. However, it is interesting to note that this does not fully represent every member of the European Union. Rather, it is more of an average out of the members. Thus, there are probably some countries with a negative interest rate in the EU. Moving on, we can see that the interest rates for the UK will be 0.25%, while the US interest rate will be 1.25%. These statistics are taken from the official website of the country's respective central banks. So what does this mean for the exchange rate? I would like to point out that the interest rates are intercorrelated with other factors, meaning that other factors may contradict the proposed forecast based on the interest rates. As said in his statement regarding the most recent monetary decision, the chairman of the Bank of England had stated that the feeling for the next decision will likely be an increase in interest rates due to recent inflation report showing high growth in inflation. Due to this, we may see the pound appreciating in value relative to the euro and the USD, most likely after the next decision in November. However, the pound has already appreciated in value ahead of any monetary announcement, thus running ahead of interest rates differentials, especially against the dollar. Thereby meaning that this appreciation against the euro or dollar might be unsustainable in the near future. Therefore, based off only the prediction of interest rates, the pound will appreciate against both the euro and the dollar. This, however, will not be sustainable throughout the rest of Q4. Other than that, the euro area interest rates are not really a determining factor in regards to the value of the euro. This is because due to the recent eurozone crisis, where multiple members of the EU defaulted on their debts, thus making economic activity stagnant and weak. Thus, the main goal of the EU is to stimulate this economic activity, thereby lowering the interest rates to boost the local economy. Therefore, we can see the euro depreciate against the pound in the near future. Finally, the US has been steadily increasing their interest rates since Trump had gone into office. This is most likely due to their goals of economic growth. However, inflation had been increasing rapidly above set growth, thus cancelling out any major appreciation against the pound. Further supporting this is the fact that the Federal Reserve had stated on their website that they no longer aim to increase their interest rates, whilst we know that the Bank of England would increase theirs. Therefore, the dollar will either depreciate based on their performance economically or remain around this rate against the pound. I would like to now pass it over to my colleague Josh on his analysis on inflation.
Hello, my name is Joshua. I'll be talking about the relative inflation rates. So CPI, also known as the Consumer Price Index, is used to measure inflation by showing the average price change of goods and services, measuring monthly intervals between different years. Relative inflation rate is the comparison of inflation rates between countries across the world, and is influenced by exports and imports. So less demand for exports will mean less demand for that currency, and more demands for imports will mean more supply for that currency. The effect of inflation rates in the UK. Inflation rates in Great Britain, also known as UK, is 0.58 on monthly and 2.87 yearly in both CPI, the Consumer Price Index, and HICP, which is the Harmonized Index of Consumer Prices that's used in Europe to compare European countries. Great Britain's inflation rate has consistently risen since the announcement of Brexit in June 2017, and according to the theory of purchasing power parity, the average price of Big Mac is at 2.29 sterling. The effect of inflation rate in Europe. For the 19-member of Eurozone, without UK, sits at monthly inflation of 0.27 and yearly inflation of 1.5. The European Central Bank targets it getting up to 2%. However, Tom at MarketWatch claims that there are concerns because the inflation rate could fall below 1% from the first quarter of next year in 2018. And according to the Big Mac Index, the price of a Big Mac is 3.91 euros. So the effect it has on US. The US inflation rate is 0.3 on monthly basis and 1.94 in yearly. There is a recent bout of low inflation in the US, however, they are optimistic and they're expecting one more increase before the end of this year. And the theory of purchasing power parity, the average price of Big Mac is at $5.30. So you would have noticed the Big Mac index in all three slides. So according to the information we've gathered, we've put sterling as the base currency, and it is shown that the sterling, also known as GBP, is undervalued compared to euro and US dollars. This also means that the euro and US dollar is overvalued compared to the GBP. So lastly, a number of reputable sources expects the sterling rates to raise as early as November this year, and the GBP rallied a 15-month high against the US dollar at $1.3590 and euro at 1.137 euros. Therefore, we speculate that the GBP is indeed appreciate in value against the USD and euro, and the USD and euro will depreciate against the GBP. Now, Ned will talk to you about the government influences.
Government intervention. Governments tend to intervene when the exchange rates are heading in the opposite direction of the expected rates. 5 major intervention strategies. 1. Creating supply or demand for the dollar/pound. 2. Foreign exchange reserves. 3. Borrowing from foreign currencies. 4. Influencing interest rates. 5. Reducing inflation. Creating supply-demand. When the government intervenes in a foreign exchange market, it aims to create demand or supply for the dollar by buying or selling it against another currency. Foreign exchange reserves. If the value of the exchange rate is falling and the government wants to maintain its original value, it can utilise its foreign exchange reserves. For example, if the British pound is falling too far, they can sell their dollar reserves and purchase pounds. This purchase of pound sterling should increase its value. Borrowing from foreign currencies. The government can also borrow currencies from abroad to be able to buy more of their currency in order to boost the money supply and increase the value. Influencing interest rates. Higher interest rates will cause increased money flows and increased demand for the dollar. Higher interest rates will make it relatively more attractive to save. Reduced inflation. Inflation has a huge impact in exchange rates and can be influenced by most government bodies, either through tight fiscal policies, which is government spending and taxation, or monetary policy, which is money supply, such that aggregate demand can be manipulated and hence inflation can be reduced. By decreasing aggregate demand, consumers will spend less and purchase less imports. Therefore, the money supply will be less. This will increase the value of the exchange rate. Lower inflation rate will also help because goods will become more competitive, thus the demand for the dollar will rise. However, this policy has an obvious side effect because lower aggregate demand will cause lower growth and higher employment. Conclusion. We have discovered that there are many different factors that influence the exchange rates and is much more complex than first thought due to the continually changing interest rates in different countries, differences in inflation at particular times, and also the choices governments make when choosing to intervene in the market. To conclude, after analysis of our currency pairs, we agreed that for our interest rates that the euro will depreciate against the pound in the near future, and the US dollar will depreciate against the British pound. However, for inflation rates, we've agreed to speculate that the British pound will appreciate in value against the US dollar and euro, also meaning that the US dollar and euro will depreciate against the British pound. Thank you for watching our group, and I hope you enjoyed it. Thank you.